There's going to be one more round of printing, and this is my opinion. And there's going to be one more round because there's going to be one more financial crisis. It's going to be more extreme than 2008. It's going to be more extreme than 2020. And when it happens, the spot price of gold and silver is going to go crazy. I don't know, $2,500, $3,000 in a few nights overnight. I don't know. I'm just putting out numbers, but it could be that extreme. And when that happens, then only after that are you going to see people in the physical market start to get more interested.
Gold prices surged to a historic peak, surpassing $2,100 per ounce, driven by investor demand for a safe haven amid uncertainties and expectations of Federal Reserve rate cuts. However, the rally was short-lived as prices swiftly dropped to $2,020 within a single day, leaving traders perplexed. Despite this sudden decline, gold managed to stabilize above $2,200 early on Wednesday, hinting at a potential recovery. This stabilization occurred against the backdrop of a subdued market sentiment, marked by a pause in the upward trend of the US dollar. The fact that gold held firm above $2,200 suggests the possibility of reaching new highs in the near future. Rafi Farber, an analyst from the Endgame Investor, has noted a phase in financial indicators that signals an impending crisis. He foresees an imminent round of monetary printing, which could lead to a severe financial downturn, surpassing the impact of the 2008 crisis and potentially exceeding the events of 2020. Rafi speculates that this crisis has the potential to significantly boost spot prices for gold and silver, possibly triggering a surge to $2,500 or even $3,000 overnight. He emphasizes that the anticipated crisis is likely to spark a significant uptick in the physical market. Despite gold consistently reaching nominal all-time highs on a daily or hourly basis, the backdrop of a contracting money supply since April 2022 is quite noteworthy. The money supply growth experienced another dip in October, remaining deeply negative after turning negative in November 2022 for the first time in 28 years. This continuous decline follows a steep trajectory downwards from the unprecedented highs observed over the past 2 years. Rafi underscores the rarity of such peaks in gold prices, aligning with a contracting money supply, highlighting that this trend might only reverse when the Federal Reserve intervenes through quantitative easing, printing more money, and purchasing bonds, a strategy not currently being pursued. Additionally, he observes a clear disparity between the futures market and ETFs for gold and silver. The futures market witnesses increasing activity from major investors and institutions, while ETFs like GLD and SLV show declining interest and reduced holdings among retail investors. Clips from Rafi Farber discussing these insights will be presented in collaboration with Liberty and Finance. Thank you and enjoy the video.
World today, you, me, everyone else, where we can see daily price moves, even minute-to-minute price moves all the time. So it kind of drives us wild. Like, if we hadn't had access to the internet and we weren't constantly involved in gold and silver prices every minute, every hour, every day, would we have even noticed that it broke to a new all-time high and then sold back down a day later? Like, it wouldn't have even been a thing. So we have to recognize where we are in the world and where we are in communications, and I'm part of it and you're a part of it. We can't really escape it. So, you know, did gold really go to a new all-time high? Yeah, on a daily trading basis, sure. But we really have to recognize that we're part of a much bigger picture than daily price moves here. Not to minimize it. I guess I am minimizing it, but I recognize it's important. But what I'm saying is more on a general level. Look, the money supply has been contracting since April 2022. What is that? That's like a year and a half, okay? Gold doesn't usually reach new highs when the money supply, meaning the dollar supply, is contracting, and it still is, and it still will until the Fed moves in and starts to reverse it, which means it has to do QE again, it's got to print more money, it's got to buy more bonds, which it's not doing. So the fact that even on our microscopic level where gold is moving to new all-time highs on a daily or hourly basis, that's something big. So don't take the sell-off from all-time highs that seriously. The fact that we're moving even to nominal all-time highs on an hourly basis is a big thing, considering that the money supply has been dropping at a record pace since April 2022. And that's going to reverse. And when it does, so if I'm saying is a fortiori, if the gold price is moving to new all-time highs on an hourly basis, if you're in the spot market, then imagine what it's going to do when the Fed actually reverses and the dollar supply moves to new all-time highs past April 2022. It's going to be extreme. So this is just a warning. Gold and silver are moving. When we say gold and silver moving, we're usually referring to the spot price, the price that you see when you're looking at the gold futures or the silver futures, and they're at a high or they're at a low or whatever it is. It's the futures price that's referred to. And the open interest in the futures market has risen very fast, whereas the ETF market, meaning GLD, if you have like hundreds of thousands or even millions of dollars, or if you're a bank or you're a really rich investor, you're not really going to buy GLD or SLV. Maybe you will, but like if you have a lot of money, you're going to buy futures because that's where the leverage is, that's where the excitement is, that's where the real money is, and that's where you can actually get physical gold and silver if you're plugged into a brokerage that can deliver that future to you. And it's possible. I tried it and I got to a point, but I know that there are brokerages that do accommodate this. So if you're a big investor, that's where you will invest, and that's where the action is happening. Whereas in the SLV and GLD markets, the amount of gold and silver that those ETFs hold has not risen anywhere near its peak, which I think was in like 2021 or early 2022. They've fallen since then. So that means the retail investors, both in the paper markets, in the people who buy GLD and SLV to have dollar exposure to gold and silver, not necessarily physical gold and silver, but they want to earn more dollars. So they want to use gold and silver as a vehicle to earn more dollars. They're not really interested in the market right now. If they were, then we'd see the amount of gold that these funds hold go up, because that's what happens when more people are invested in GLD and SLV and they have to maintain their peg, like an informal peg to the futures market. Then they have to put more gold and silver into those funds in order to expand the share count, in order to keep the price level with the futures market. So the fact that gold and silver is the amount of physical gold and silver in those funds is falling means that the retail investors in those funds are losing interest.
Money is exiting reverse repos as firms find more lucrative returns by investing in private securities, and a surge in Treasury bills is diverting their attention away from the central bank. According to J.P. Morgan economists, they noted on Thursday that reverse repo balances are expected to further decline due to the dynamics of Treasury debt offerings. The ongoing reduction in the reverse repo facility raises questions about how much further the Federal Reserve plans to shrink its balance sheet. Fed officials, however, believe that the process still has a considerable way to go, even if they have completed rate hikes. Notably, at least one central banker has suggested that reverse repo take-up will return to zero before the central bank can contemplate halting its balance sheet wind-down. Rafi highlights a correlation between the diminishing reverse repo activity and potential involvement in financing Treasury purchases. This observation reveals a consistent pattern of decreasing reverse repos coinciding with each Treasury auction, implying a plausible link between these two financial aspects. He speculates on the potential repercussions if Treasury auctions were to falter due to insufficient funds. Such a scenario might prompt a response from the Federal Reserve, possibly leading to a reversal. Rafi is exploring the possibility of a larger money supply to counterbalance its current decline, warning of potential significant consequences in the financial system. Now let's return to the interview.
If reverse repos are zero at a time when interest rates are 5%. So who is buying all of these treasuries on the primary market in the treasury auctions? Where are the dollars coming from? If the dollar supply is shrinking, there's got to be new dollars to buy these treasuries, right? So they must be coming from somewhere. They're coming from the reverse repos. We know this because every time there's a new Treasury auction, the reverse repos shrink, right? So they're coming from the reverse repos. So if there's no reverse repos, who bids on the Treasury auctions? I mean, there's some theories out there of articles that I've read that the reverse repos, instead of people lending cash, instead of banks or money market funds, whoever they are, lending cash to the Fed, getting securities in return. So when they run out of cash, okay, so fine, they'll lend securities to the Fed in exchange for cash with which they'll buy treasuries, but then they have to return the treasuries to the Fed the next day. I mean, this thing becomes very, very tight. And again, like, I'm speaking as if I'm an expert, but I admit that I'm not, and because nobody really is, and even Jamie Dimon isn't, and because if he was, he would have predicted the apocalypse in 2019, but something like the apocalypse is going to happen again. And some kind of treasury auction is bound to fail if there's no money in the system to buy those securities. Exactly when that happens, I don't know, but I can see the same thing happening now. Not the same exact, but something parallel happening now to what happened back in 2019, because we're running out of extra dollars. And you can see that because the dollar supply is contracting, because the Fed counts it up to the dollar every month. And it's shrinking. So, like, who's going to buy these auctions? I don't know. And what happens then? Something's going to break. The direction we're going right now is down in the money supply. And if you're going down in the money supply and up in the debt supply, which borrows from the money supply, like, something is gonna snap here. You can't have more borrowing of money from a lower and lower money supply. Eventually, you have to grow that money supply in order to satisfy the borrowing. The question is when that break occurs and there's like a huge meltdown in the market of some sort, like happened in the repocalypse or happened in 2008. These are all just reiterations of the same thing. Then what is the extent of it, and what happens? Well, you know, if you, in just a very basic zoomed out sense, right? When the Fed creates more money, it gives it to financial institutions which loan out that money, which then have more debt that they need to be paid back. So they need more money to pay back that more debt, which means axiomatically almost that these institutions need the debt to expand exponentially. So when the next break comes and these institutions that need exponentially higher debt to pay back their own debt that they're buying from the Fed or from the Treasury or wherever it is, when they need that, then the Fed needs to print exponentially more money. And the question is what happens to gold and what happens to people who need purchasing power when that next round happens. Like, eventually the rounds become too extreme and people just dump the currency and then get ahead of the Fed. When hyperinflation can be defined in many different ways. One of the ways in the logic that we're speaking now is when the public gets in front of the Fed and dumps the money faster than the Fed can. The question that we all want to know the answer to is that going to be the next round, or is it going to be a round after? I think it's going to be the next round. Could it be the round after? It could be. I don't think it will, but whether I'm right about being in the next round or it happens, a year or two or three later in the round after that, I don't think it will. I'm just saying it's theoretically possible. I don't think it matters in the scheme of things, and I'm glad to be part of the people that are warning now, even if I might be wrong about now, because we're right. and people got to get out of it.
The consensus among most analysts suggests that gold prices are poised to reach new peaks in the coming year, potentially maintaining levels above $2,000. They attribute this anticipated surge to factors such as geopolitical uncertainties, a probable weakening of the US dollar, and the potential for interest rate cuts. We're eager to hear your insights on the interview. Please share your observations in the comment section below. If you found this video informative, don't forget to give it a thumbs up, subscribe to the channel, and activate post notifications for more content like this. Thank you for watching.